Uh, Welcome to this webinar on something which a lot of people have said is a very interesting one, okay, on how to identify a multibagger, right? So before going further, I thought let me just run a bit of a poll, right? And Sanjay, can you help me on that? Just for me to assess as to where we are and what we think of a multibagger, right? So, okay, I see some very good polling that's happening, a good number of responses. We just give maybe a few seconds and then we will pause the poll. Okay, thank you. So we will share the results. Yeah, so it's interesting. I think most people have said delivers 100% returns over a period. About 53% have polled in that favor, while 25% said delivers 30% return in a year, and another 22 said it delivers 50% returns in a year. So what is a multi-bagger? Basically, it actually is something which has gone up more than 100%, which is where we normally use this language saying, the stock has gone up 2x. 2x means, if you've invested 100 rupees, it's gone up to 200 rupees. Okay, that is 2x. And that is what a multi-bagger stock is. I thought, let me, share that with you and also set in context the understanding of, let's say, what is a multi-bagger stock. Yeah, so I think we can stop the sharing. Sanjay? Yeah. So just stepping back, as to what are the different, types of stocks that one has, where we look at it from, two frames of reference. One is in terms of valuation and one is in terms of growth. Here we are basically talking growth in profits. And you will find that sometimes there are stocks that, are not growing as much, but in some form, the valuations are very low, right? So a lot of people also go through with those and look for those value stocks, right? So, and value stocks in exclusion, in our view, is a bit of a, value trap, okay? Because maybe if you're lucky, the valuation will expand, but over a period of time, you may just find that it's not consistent, and it's difficult to say when this price actually unlocks. It'll probably unlock at the last leg of the bull run, where all the junk runs up, and when the fall happens, they also fall the most. So the whole point is, I think, one avoids some of these value traps. On the other hand, you also have a few stocks which growth is moderate, but they are very consistent, and they are also compounders, as consistent compounders, as some call it as. The issue with the consistent compounders is, over a period of time, you'll probably find that there are periods in when they work, and there are periods when they not necessarily work. And the periods where they don't work is, when maybe, the market is willing to take that higher risk. Okay, because at periods when, there's a lot of uncertainty that, for example, the last decade when, there was uncertainty and, we had, 4 companies of AAA rated, which is the best credit rating, go to default. You found some of the financial institutions, have a high NPAs, and there was some bit of stress around there. In periods like those, definitely, the quality of the consistent compounders did extremely well. But when, say, growth comes back and investors are willing to take a little bit more of risk, you may just find that, doesn't sustain as much. So at a point like this, when, we believe that growth has come back, and, it's time to take look at multibaggers. We, of course, what will help achieve those multibaggers also is the valuation, right? So if the valuation is moderate, now it's very unlikely that a high growth stock, which is sort of doing very well, is at a low valuation. It's very unlikely. Okay, so it's possibly that you have something which is a moderate valuation, and where you have a high growth rate and profits, you'll probably find a multi-bagger, and that's sort of where we sort of go after. And the point is, how do we do it as a process? Because you may have a portfolio of say 25 stocks or 20 stocks. You just don't want one or two, right? So the whole point is, how do you get more consistent, multi-baggers out there? Uh, so the second aspect that we've captured in this is, you will find that there's a linear relationship, okay, between, if you see the price by book, which is one form of valuation, and the return on equity. So the effort is to look for those which come in that attractive valuation range, and at the same time are ones with a high return on equity. So which means the company is delivering good profits on its equity, and it's using its capital well. Stepping back a little bit, I think before getting into identifying, say, multi-bagger stocks, I think it's very important to have a very good disciplined investment process. And the best way for me to do it is to talk about, say, the right horizons processes that we have built in our whole, say, PMS investing journey. And so we have broken up our journey into, a screener where we actually shortlist a few companies from the whole universe of companies, and we do it, by certain filters. We do it by certain exclusions that we create. And if you see, some of the parameters that we captured there are slightly longer term, 3 years CAGR in sales, 3 year CAGR in 3-year average return on capital employed, earnings growth over 3 years. So we try to look at it not just one flash in the pan year, but over a longer period of time, so that we get consistency. Then we actually go into ranking each of these companies on almost like 25 plus parameters. Okay, on different segments. You may have some on valuation, you may have some on growth. So on various aspects, we sort of look at it and try to come to a smaller list, try to come to a ranking, and from there, we pick and choose companies, based on the ranking that they are at. It helps us to be a little less emotional about the stocks, and actually it also helps us to see where something is going out of rates, right? A lot of the time people look at, what are the stocks to buy. I think we believe what is a very important success factor is, where you are able to sell and sell at the right time. Of course, we also go some bit further into looking at each company that we have. After a short list, we've looked at a fewer companies to look at. Then we deep dive into those, look at their strategies, look at any headwinds, tailwinds that they face. Okay, and we then arrive at the companies that we want to look at. We look for emerging stars. Okay, we look at valuations. Like one said, valuations also play an important role apart from the company itself. The other process is actually to look at the risk side, and risk is very important for us, as our investment philosophy is more about delivering a risk-adjusted return. Okay, and looking at the risk aspect, right from the corporate governance side. We start off with doing a bit of a forensic check, including legal background verification of the promoters. Today there's good information which is sort of available, and that is helps us to do some of these checks, apart from a lot of the financial parameters that we sort of look at. The pendulum is a way of looking at stocks to enter, and more importantly, like I said, to exit, and that actually helps us and has helped us in the past exit some of the stocks where we found the valuation is higher, because our view is, in order to manage risk, we also want to exit stocks where valuations go high. And sometimes we exit it even if we are reasonably confident, about the company and how it will perform. But what happens sometimes is, stocks go ahead of their valuations, and subsequently they either correct or they become, go into low return zones for a long period of time, and we'd rather go to some other company which we think will sort of do well. At the same time, uh, what we are finding is where there's consistency, where management is strong, and we don't see many a times a real high churn when we look at it, but we only look at it where it moves out of the extremes. Okay, because you don't want to uh, exit a company which can go up, say, 5x or even 6x, right? So, so, uh, so we don't want to do it at a very short-term basis and looking at a very short-term outlook, but looking at more, points which go out of the extreme for a company that is doing very well. Or it could be companies where something has deteriorated, right? Or the sector we believe is likely to face headwinds. So sometimes those are the aspects that we look at apart from the pendulum. Now, coming back to what we believe is a multi-bagger framework. So there are two parts to it. One is looking at growth. And like I said, growth in earnings is what we look at, basically the profit after tax. And if that is growing, well, for example, we look for, companies where their profits can double, okay, over at least 3 to 5 years, okay. So, and if we think that the profits will double, I think the natural corollary from that is that, you'll also find the stock price more or less will double because, you'll find that stock price in the long term reflects the growth in earnings. And the second part of it is like on valuation. So what we believe is that if you have a stock at a reasonable valuation, you also get one more engine for stock price growth. And that is, it can expand and it can re-rate. And why do these companies re-rate many times? When let's say a stock is just discovered, you find that smaller research houses, brokerages, etc., start looking at it and get attention towards it. But over a period of time, you will find that institutions slowly start coming in, and when they start coming in, you will find the valuation really increases, and that is where you have a bit of a re-rating as well. Apart from just consistent performance, return of, and growth in profits of the company also will attract more investors, right? So from both aspects, both institutional and retail investors, they come in and help the stock to re-rate, which means what we are saying is, let's say the P multiple from say 25 moves to 30 or 35. That's what we call as a re-rating. So the whole point is, how do we get the stocks which we think will double in a period of time, as well as has lower valuations in relation to the sector itself. So combination of these actually deliver returns. At the same time, it's important to see that there are no value destructors, okay? Because one side maybe the company does well, but you could see value destruction from various factors, and that may also take out, even though we expect, for example, a doubling of profits, there may be other risks that do not allow it to happen in actual reality, right? Because a lot of the time you are looking at in anticipation and in expectation, right? So you need to go back and look at, what are the business risks which are there for the company. So it's not just about, you invest in it based on expectation and then leave it. No, one has to continue to track it. So there's hard work right from the time of looking at a process to it, in terms of process of investing into a stock. But also I'm saying there's a process where you need to track it. For example, we track every quarter earnings, every management call that comes in from the companies that we hold. In fact, for the mid and small cap companies, we also, especially small cap companies, we like to even go and visit and have a look at the facilities and plants, talk to management, because that sort of there's a lot of things that come in the underlying when you look at it, and many times you see the risks which you may not see just on paper. So that is something that is important to do. The other part of it is, valuation risks. And, one needs to be able to assess, is the valuation justified by the growth in earnings of this company, right? Or the second could be at, if there's a low margin of safety, and if the margin is very susceptible, for example, to cycles, of the industry cycles, then you may find that, it is something at risk. So one tries to avoid some of them. And the last is about corporate governance risk, because, especially when we look at some of the smaller companies, it is reasonably, well known that, the quality is definitely something that one has to be very, very careful about, because, you need to ensure that you have got a company which is actually looking to grow themselves well as grow the wealth of all their shareholders. If that is not there, then, you may just find yourself, losing all your money or losing a good part of it. Apart from looking at earnings, apart from looking at valuations, I think what are some of the factors that can help, say, earnings growth, for an example, is, identifying trends. And this is an example that one is captured here, where you look at consumption versus, per capita income. How is it moved in other countries? And so you draw a parallel and say, okay, as that rises, right, what has happened? And you have a history to it elsewhere. What is likely to move now, right? So there, a lot of the time, there are cycles that play out. Example, if we went back, the telecom boom that India saw, right? Many of the FIs looked at it elsewhere and said, yes, this is likely to happen in India, right? So even today, there's a lot of expectation that what the baby boomers type of period that the US saw is likely to sort of come to India. So then you see, okay, what are the sectors which are going to benefit from it? And those are the ones that you go after. For example, do you do IT or IT services or products, or do you do manufacturing, core industries? It would depend on, what is the expectation of the future and what are the trends that you see. And just to give you an example, Super Value is a mid-cap portfolio of ours, and this is an example of how we have done that. And maybe there's some bit of learnings from there. So if you see the fourth column, which is basically the earnings growth, each of these companies, and these are live examples that companies that we've invested into Super Value. The disclosure is that we have sold some of them, a number of them at high value, which are at high valuations, and we continue to hold, a couple of them. So this is not necessarily a recommendation for you to invest right now, because sometimes it's possible that we are the last leg of it. Okay, so this is not a recommendation for you to buy these stocks. Okay, but just to give you an example, the IRCTC, for example, when we bought it, it was 35. When we sold it, was 105x with a P, right? So it was, which means, the stock price was 105 times the profits of the company, earnings per share, right? So that's how it did. So there was a valuation expansion that happened. There was a re-rating that happened. Apart from that, the earnings grew up, doubled, in that period. So that is something which, allowed us to see a return of almost like 6x on that stock. Okay, similarly, you had Neogen at 5x, KEI at 4x. The stock has further gone up from where it was. Okay, so you'll see that it is possible to actually make a system out of it, and identify multi-baggers. And this is an illustrator one, like I said, and this is not a recommendation to buy some of these at the current point of time. The other is, again, looking at trends, because our experience is that mid caps and large caps move in phases, right? So you will find that in periods when there are almost like 2-3 years when large caps run up relative to mid caps, and mid caps go slow, and there are periods when, say, mid caps run up and mid and small caps, I'm saying, and in that period, sometimes large caps go slower. It's not necessary that they don't grow, but they grow slower. And one of the other things is, you may see, okay, what are the relative valuations? Look at data. I mean, a lot of our decision making is driven by data, and that helps us be less emotional about it and probably see returns out there. So the small cap, for example, we found it was a discount, and that helped us, take a decision there. Again, I'm giving you a framework as to how we are looking at with the live examples, so that you may also be able to do it yourself. Okay, looking at small caps, for example, the other one is because even now people are asking, oh, you know what, small caps have already run up, right? And so what do we see from the past? We see from the past that these moves are not necessarily small, and the time period also is not necessarily small. So typically you'll find anywhere between, somewhere around 24 months as an example of where, the moves are. And the period that it was 6 months, actually, if I look at it right at the beginning, there is the second move, okay, that happened there. It was actually part of a much larger move. So if you looked at from April 2003 to almost like 2008, it was almost like a 7x type of move that the market saw. So that is something that sort of we keep in mind, and which is why it's important to also look at some of these cycles and gain from it. Yeah, the downside also I want to highlight here, because while things go up 3x, if you don't exit out in time, right, then you may just find that the falls also can be large. So it's not unusual to see a 56% fall, right? 50% fall, right? So that is something which sort of one keeps in mind, that when you are sort of looking at a cycle, look at both sides to it, and then you need to see how to play it out. While the gains are say 220%, if you see the bullets at the top left-hand corner, the gains are, and from the bottom are 220%. Okay, the average decline from the peak is also 45%, right? So one needs to be careful when one looks at things. And again, we look at another perspective, because you want to be confirmed that, okay, do I think, say, small caps are likely to do well, or mid caps are likely to do well, or large caps are likely to do well, right? So if I look at relative valuations, small caps are relatively undervalued, which is basically looking at yield of small caps versus large caps. Okay, so you will find that in periods like 2016-17, when there was a great rally in small caps, you will find that it was right at the bottom of the chart, and right now it's closer to the green line at the top. So basically, small caps are undervalued, and when you find that they grow relatively versus large caps, you will find that this will come down to the on the downward. So it's an inverse relation actually in this particular chart. So that is something that one keeps in mind. But again, I'm emphasizing that if you see this, and when you're playing with small caps, you should keep in mind that if you have a top quartile stock, right? If you are in the top quartile, it has given a 10-year CAGR of a staggering 37.2%. Okay. The flip side to it is, if you are in the bottom quartile, the average is only 2.2, right? So it's important. And the index on the whole has delivered, say, 16% in that 10-year period. So good returns, but if you're able to, get a little more in-depth, study the companies better, and able to identify the top quartile stocks, not even just the top 10, so basically it will end up, doing pretty well for you. The other is, again, highlighting the risks as well. Okay, because I think it's also important to look at the flip side to things. What we don't do, okay, is these are some of the rules that we have put for ourselves. We don't invest in stocks which have a low addressable market share, because if you'd rather have a reasonable share market share growth, right? So, and the market is large enough for it to grow as well, to be able to look at. We don't look at companies which balance sheets are very negative, broken. At least in this particular strategy and in small caps, we uh, we like to look at ones with good balance sheets, because there's that margin of safety, which basically means that even if there's a down cycle, then, if you have companies which are stronger, you may find, instead of it going down 60% or 50%, you'll find that it'll go down, say, 25-30%, which is maybe in line with, let's say, a fall in a large market cap stocks. Okay, so that will sort of give you that safety. You're not going to see, the large falls, if you invest in companies of good quality. The other is about, companies with high pledging by promoters and low promoter holding. Again, we sort of avoid. We don't do stocks which are very, have a lot of loans, which are highly leveraged. Okay, and we avoid businesses which are cyclical. We like to see, path to profitability. Okay, and possibly path to increasing margin and higher profitability. So that is something that we look at, as well as we avoid, companies with poor, disclosures, because that sort of gives us an indication as to, how the corporate governance of those companies are, right? And so based on some bit of our analysis, etc., we ended up launching the super value aggressive. Okay, and this is a example of, how we sort of looked at it. We've not given the names because this is a live portfolio, and one didn't want to, from compliance perspective, I, don't want to disclose that. Okay, so you find that the companies are at almost like a 30 to 50% discount to the sector multiple, which means that the sector multiple is the P ratio of the average P ratio of the sector versus what is the P ratio of the particular company that we are talking about. And the second part of it is, we believe that earnings are likely to grow 2 to 2.5 times in the next 5 years, right? So if these unfold in the way that we expect, okay, a combination of these two factors will actually, see some very good multi-baggers, and possibly, my experience is that when say, small caps and momentum, you'll probably see higher than this as well, because markets overdo on both sides many times, right? So it's you probably see even higher than this. So how do you make it a process is what I'm saying, that, will help you achieve that multi-bagger. Just a slide on how we have done, and the consistency of, returns on a 3-year basis. Flexi cap is a multi-cap strategy. Super value is a mid-cap, and underserved is a small cap strategy. And they've done reasonably well, got good ratings from, PMS Bazaar, which, uses a, crystal methodology, and that has sort of done very well for us. In conclusion, how do you identify a multi-bagger? First of all, it's easier said than done. It involves a lot of hard work. It involves a disciplined process in investing. And if you have a disciplined process in investing, you'll probably, identify it consistently. Okay, because what will otherwise happen is, you may have some stocks do very well for you, some stocks fall off the cliff, and in the end, you come back with a return which is average or probably suboptimal, right? So one needs to look at it in a proper process and look for consistency. There are two key aspects for identifying, a multi-bagger. Okay, one is looking for companies that double earnings in 3 to 5 years. Okay, so if you find companies that double earnings in 3 to 5 years, I would believe it's very natural for the stock price to also double in that period, and probably more, as if the second aspect comes into play, where you look at valuation and look for companies where you expect valuations to expand. So these two together, we believe will help you achieve that multi-bagger returns. Earnings growth can be identified also from trends. So because how do you go to underlying factors of how do you find companies that are likely to double earnings growth? Okay, that comes from looking at trends, identifying trends and themes, and then it'll help you deliver it sort of better. Uh, for example, the trends need not be just the consumer market, how is it moving, or how whether manufacturing is moving. It also includes looking at whether large caps or mid caps, looking at even the overall cycle. Is there likely to be a fall in the market first, or is it likely to rise? So combination of looking at a lot of these trends, okay, can help. And if you're able to get the trend in market cap, for example, then you'll probably see some of this movement much faster. Okay, and that will sort of help take it much higher. Uh, the relative valuations so for example, we launched Super Value Aggressive as a fund, right? And interestingly, we would like to keep it open only for a shorter period of time, right? And what is the reason for that? Even though most investors unfortunately tend to invest at a peak, right? And we are probably saying that we will not participate in that growth, which could have come to the organization, as an asset management company, right? But we're saying that we will stop it, say within the first 6 months, and that is another, say, a month or so away. We plan to stop it for, say, investors. We'll probably take it for distributors maybe for a couple of months, and then bring the fund to a close. The reason is we don't want investors to come in at a high, right? And we believe the first 6 months out of a larger 24 months has reasonable margin of safety, even if, say, we miss the cycle of exit, right? So that's the first safety thing that we are saying. The second safety mechanism that we are looking at is we're also saying that if we feel uncomfortable with valuations of small caps and the companies as a whole, we don't mind even shutting the fund and giving it back to investors and moving it into either some of the market cap size to become a little conservative, or even moving it to cash and doing systematic transfers or whatever, right? So our philosophy also is to look at this fund possibly for a limited period of time, both on the entry as well as likely the chance of an exit also, and closing the fund, because you want to take it out and enjoy the returns and not go through the larger fall that can come into small caps. And that's again one is sort of highlighting the risks of investing in small caps, because I think it's important to, while one identifies the trend, one also knows what can be the downsides to it. The falls can be large when cycle turns, right? So that is something that one keeps in mind. So like I explained to you, we look to exit it when the trend peaks. In our view, the quality of stocks is important. Okay, and the illustration that I showed, okay, and the actual data actually, where it shows that bottom quartile stocks deliver no returns. Okay, so even though the returns of top quartile stocks was almost like a staggering and superlative 37%. So that's all I had. I thought this time we'll keep a little more time for questions from all of you, and so I leave the floor open to questions. Sanjay?
Thank you, sir. Thank you for sharing valuable insights. I will be reading out the questions. Meantime, I would like request all the participants to type out your queries and questions if you are having in the Q&A sections. We will be taking it one by one. So the first question is, are you convinced with the recent rally or think valuation is expensive now? What should be my return expectation in the market today?
Yeah, so what you can expect is a lot of time news flow can sort of be the opposite, and you may just find uh, you know there's a lot of news around say markets at a high, right? In fact, a lot of the media queries to me have come over the last few weeks has been markets at a high, what one should do, right? So I think one steps back again and looks at it from a perspective that uh, actually we don't believe markets are at a high if you look at from a relative valuation standpoint, right? When you look at an absolute number, now absolute number actually is irrelevant because the index is only an aggregation of it, and as companies go forward their earnings will go up, and that will continue to grow. So it will continue to go to an infinite number, so there's no cap that can come. It's not like okay, as a person you can grow only to a certain height, whereas in the stocks, if the earnings continue to grow, you will find that the market will grow. Similarly, what happens is the market also, uh, the way the index is constructed, companies where which are not growing will automatically go out of the index, and you'll find something else come up. So it's an index which is also moving and varying. So my thing to you is that we don't believe that markets are at a very high valuation. In fact, if we looked at it, pre-COVID, we were uncomfortable with valuations, and we did a profit booking. We got into cash. We took various measures, which is why on COVID, our funds fell lesser. Okay, and it was in our view, if it was not COVID, it would have been something else, and market would have anyway corrected, because that time the P ratio of the whole index was 29 times. Okay, and from there, interestingly, after COVID, it did fall, and while the markets grew, our earnings grew so strongly. In fact, the last webinar I did capture the chart on how earnings grew. Right, earnings grew at a staggering pace. So, despite the growth in the market that we saw post COVID, the P ratio actually came down to the lower 20s range, and in fact, in some bit of volatility that we saw, from October of 21, okay, to March of 23, it went also went below 20 as well, which is a good price to buy. Even now, we're in that 20 to 23 range. So we are possibly at the lower end, and we think earnings also grow, which means that you'll get a benefit from earnings growth, and P ratio will again, sustain for a longer period of time and more than what people expect in our view. So I just wanted to give a reasonably detailed explanation to this, because you have a perspective that many times there's a lot of news which is on the opposite side of what you should be doing. Right at the peak, everything will be growing very well. Okay, and you that time you'll probably find all positive news. So similarly, at a time when there's a whole lot of news which is negative, in fact, we came out from a very negative period. We came out with a report, a contrarian report, from the end of March of 23, saying that we think markets will do well for this financial year, and we stuck our neck out that mid and small cap stocks will do well. Right, and the chart, like I showed you, the moves are not necessarily short, right? And so one thinks that there's more room to go.
Thank you, sir. The next question is, do we find multi-bagger stocks in falling sideways market or also or only in rising market? It is necessary for a multi-bagger stock to be low liquidity and undiscovered stocks, or we can get multi-baggers in non and liquid stocks also.
Yeah, so the consistent compound is an example. Compounders is an example where we had multi-bagger stocks from discovered names, from relatively larger cap names, and those are great engines of companies which have done well for a long period of time, right? So it is definitely possible to see it in periods, in larger companies and companies which are relatively stable. We had the likes of HDFC Bank. We have the likes of Pidilite, Asian Paints, all of them which have done very well and been multi-baggers, right? So those we can see also with larger names. And yes, the only point that I'm making is there's a period when and those stocks in sideways markets will actually do very well, right? So if you look for stocks which can be multi-baggers, at that time, you should not do a small cap in sort of periods where there's uncertainty, volatility, or small cap or mid cap valuations are relatively at a high versus large caps. So at that points of time, you need to be with large caps, and there are multi-baggers that you can see. Yes, so the small caps in the cycle can give you very fast periods of doubling or more. Okay, so those opportunities you can take, but definitely it's available across all. Small caps can give you a very quick multi-bagger returns in a short period of time. Yeah, the large cap ones will probably be a lot more consistent, but say over a 2 year, 3 year, not 2 year, maybe a 3 year, 4 year period, you may find them also doubling based on the earnings growth and potential expansion in multiples as well.
Thank you, sir. The next question is how to find the stock is overvalued.
Yeah, so it's not easy, some of it, but what we look at it is first of all the stock itself. You know, in fact, what was interesting is some of the even institutional investors, etc., came back and saying India is a little overvalued versus the rest of the world, right, for a period of time. And so they were looking at, let's say, other markets which are relatively more saturated. Now, similarly, you may say a HDFC Bank looks overvalued, right? So you may find periods of higher valuation and stuff like that. Okay, so how do you look at it? You first of all need to look at it, the stock itself, in what ranges its own PE has been, number one. Secondly, you look at, say, what are the valuations of let's say the other peers, right? So you will look at the industry and say, okay, is it relatively higher valued or is it relatively lower valued? And thirdly, what we also look at it, we look at because we do financial modeling for each of the companies, and we will look at saying that, okay, this is what the earnings growth that we expect, and relative to that earnings growth, in fact, you have a ratio which is called a PEG, which is PE by growth, right? So that a ratio like that will help you, or even just looking at the valuation and saying, okay, ideally, if this stock, the earnings are likely to grow at a slower pace, okay, or is likely to slow down a bit, then maybe the valuations that were there earlier also may not sustain, right? So one needs to look at it from sort of multiple factors to be able to come to a decision on that.
Thank you, sir. The next question is FII increasing their shareholding in a company is good sign investing in that stock?
Yes, so it's interesting that there can be answer both ways, right? For that, so even I remember in March, some people who had conflicting views with our view that markets will go up were saying that FIs were selling very high, right? So our point is we actually look at that, and where they're at extremes, interestingly, there are inflection points. So a very high negative, FI outflow for us is actually can be a buy signal, but at extreme points. Similarly, here I'm saying that in a stock, it's very good if an FI is coming in and it's not reaching a saturated point of time, right? So growing is very good, but if the growth happens too much, in FIs, then one sort of pulls back. You have to then look at relative to other companies, and stuff, and in itself the company, and because if the FI holding is very high, if there's a phase where FIs sell, right, so then you will see a negative one. But at a broad level, if especially now when FI is coming out of a negative cycle and our view has been that they are going to continue to keep investing into India for a period of time. Yeah, in this period, yes, FII's holdings can also do relatively well. But I'm just saying, watch out for points where they go to extremes.
Thank you, sir. The next question is, before selecting the multi-bagger stock, is both fundamental analysis and technical analysis is needed, or only fundamental analysis enough?
Yeah, so we have done and experimented, over the years a lot, fundamental, technical, and stuff. So we came back to the point that, in fact, you go back and see how many fundamental investors are very well known and reputed investors, and how many technical investors are reputed. You'll find most of them lie with fundamental, right? So our view is also, and we've tried in the past. We sort of did test portfolios purely on technicals and stuff. There are periods that they don't work too well, and the long term, it's very difficult to sustain. So we keep fundamental as the core. What I do, however, is for my market cycles, I look at technicals. I also follow a few people, including some of the global guys, okay, who sort of are Elliott Wave guys and stuff like that. Those are points where I may track them for years together, but take a decision only at extreme points, right? So when I feel that there's a likely change to happen, etc., so we look at it, and that helps us also give us a first trigger, or sometimes the first red flag, for a likely turn that sort of comes in, which fundamentals sort of may lag a lot of the time. So we use it, but like I said, at for looking for turning points, but not necessarily too much for at each stock level. There we depend a lot more on the fundamental side.
Thank you, sir. The next question is, how long is super value aggressive fund open for investment? How much returns can I expect?
Yeah, so difficult to say what the returns are going to be. Okay, the only thing we expect it to be very high. Okay, but however, one needs to keep in mind it's not suitable for everybody, right? And it's not suitable to put all your money in. Okay, so ideally, what a fund like this is, let's say you have some reasonable money in, say, like we have a flexi cap strategy. So equivalent of that can be the multi cap, or have some bit of large caps, have even some mid caps, and then have small caps, right? So that is something that one keeps in mind. Yeah, so we are looking to close it, by the next month or so. Okay, and so that's broadly what we are saying. I don't want to give forward-looking statements on, what is that percentage likely to be and stuff. Yes, the returns so far have been superlative, and almost like in a couple of months, it did 25%. And even now we are seeing, it's not unusual to see stocks which are running up, say, over 10% in a single day. Okay, as they sort of get discovered, and especially when we see results come out. Okay, it's very, very heartening to see a lot of those results, which again gives conviction, that because if the results start an uptick, right, it doesn't just stop overnight. In fact, it even has say at least a 1 year base effect, because I'm just saying, for example, if a company, just to give you an example, say at a 50 crore profit, and suddenly it sees a 50% growth in profit to 75, that trend is likely to last 1 full year, because from 75, it'll probably, even if it stays where it is, because the last year is almost like 50% down, it's likely to be, okay, it shows that growth. So that is something which, we think is a little sort of sustaining there. So, so broadly, just to summarize, I don't want to give a number, but one is based on valuations, etc. One believes that small caps will do very well. Okay. Again, I want to emphasize that don't expect 25% every 2 months. Okay. It's one would rather say yes, be at the higher range of, let's say, equity returns. And that's what I would like to say. Uh, yeah, go ahead.
Thank you, sir. The next question is, buying a stock cheaper than others in the industry guarantees good return. So I'm asking because in one of the slides you presented how stock in your portfolio have lower PE compared to other stocks in the sector.
Yeah. So yes, I also had one chart which I said just looking at low valuation is not enough, right? So the value traps are there where the company is not also growing too much and the valuation is low. In this period of time, if you're a very active investor, maybe a little later to a last leg of the market move in small caps, they'll probably do well. But then you're playing with real fire because when they fall, also they fall very, very sharply. But if you look at a combination of lower valuation as well as company doing well, we believe yes, that's a good place to be.
Thank you, sir. The next question is, exit from multibagger, is it difficult? When to exit? If we check fundamental, it will reflect late. When it falls like anything. What criteria for exit?
Yeah, so it's not easy, but like what we do and the data points that I showed you, right, of how why we suggested small caps and why we thought the tenders coming in, right? We continue to track them right through. Okay. And there are points where we believe one is the overall market itself is looking at risk. Okay. The second is relative valuations of small caps are very high and come to certain extreme levels. Like I said, a move in the positive direction is good, but there's an inflection point, right? So we look for those inflection points again, look at a whole lot of data items, right? And that probably at a slightly macro level and not even at a micro, because companies may be at different stages, right? And company may be at a great stage, but when say the fall happens, okay, you'll probably see some bit of headwinds that the company faces as well. But more importantly, when the whole sentiment is bad, it's not likely to do as well as it would have done otherwise. And there could be also corrections that just because of market sentiment, which may reverse later, but they may still come down. It's very unlikely that you see something going up completely while everything else goes down. There may be a few of them, but they are sparks, and you don't want to invest in those outliers because it's very difficult to repeat outliers, right? So that's a broad perspective from my side.
Thank you, sir. So I think this is the last questions which we can take. So this is the question is, which sector stock will be multi-bagger in your perspective in 2 to 3 years time?
Yeah, it's difficult to say, but some of the sectors that we have liked is things more closer to sort of manufacturing. Some of the building material sectors are the ones which we have sort of positive on. We think some of the financial services are things which are likely to good. Again, the consumer side, but there one has to be careful to see, what are the ones which are emerging, and growing their whole engine well, right? Because it's not necessarily easy to come into a leadership position, right? So companies have all that it takes and gets, right, to move into a leadership position is sort of what one looks at. But there could be, across sectors, right from looking at ones which have taken a breather like pharma, etc. In the diagnostic side and stuff. So you may have some of those which also sort of come back, and we watch them, like to get into a trend early. Okay, we like to leave some of the others which are likely to be at the end of the trend. But again, just to say, for example, the technology side, you may have variants which may see a good future as we go forward. There may be some of them which sort of, are, say, in old technologies, etc., which may not do as well. If the company is in emerging technologies, which we've seen in the recent days, they can really continue to sort of grow in such periods of time as well. So you cannot have just a single sector view, right? You have to look at even within the sector, there are segments which may do badly, there are segments which may do well. So I guess all the best, okay, in your journey to identify multi-baggers.